about where this goes from here. Let's stick with it and get the street's reaction. Guggenheim Securities entertainment and media analyst Michael Morris joins us now. He's got a buy rating on the stock and a price target of 105. So is Disney in better shape than it has been a year ago, Michael?
Well, better shape's a tough question. I think there are some pros and cons in the context of the topics that you just brought up. But when I look at it, I just want to take a step back and think about the investment thesis here. I think there's two things for investors to focus on. One, which is the core of your question, is this a collection of assets that can create sustained value for the long term? And two, are we getting a good price on it here? And I do think that the answer to each of those questions is yes, and that's why we have a buy on the stock. But to address your question specifically, are they in a better place? I think on the entertainment side of the business, which includes the direct-to-consumer business, which is now profitable, as you highlighted, I think they are absolutely in a better place, and that's reflected in the very strong film performance that they've had over the last 4 films that they've released. On the park side, are they in a better place? I think the answer is no. They are not in a better place per se, but I think that's a function of the macro economy. And I think that that overhang of uncertainty around what is happening with the consumer, you highlight in the article from the New York Times today, is an important component of that, but I think there's more to dig into there.
Why? I mean, hasn't the strategy been price increases? And we're seeing a similar strategy as well on streaming, which in a tougher economic environment isn't as hot as we can see with parks.
Absolutely. But I still think you have to separate two things. Are we talking about a macroeconomic call on this particular stock, or are we talking about their strategy for long-term value creation? So is it a cyclical problem, or is it a sustained problem? I'll take the two topics. One, with respect to the price increases at the Disney parks, certainly there are going to be questions about the health of the consumer and whether the company got ahead of itself in its pricing in a period of very strong demand post the pandemic. But I look at that article today from the New York Times, and I think there are two sides to it. On the one hand, you're certainly highlighting, we're highlighting or having highlighted how expensive this premium product is. At the same time, it's highlighting how consumers have such a passion for the product that they are willing to save, spend ahead a bit for what they consider a unique life experience. So when we talk about the intrinsic value of this asset, I certainly think that that is reflected in that article. That said, right, nobody knows about what's going to happen with the consumer from here, and certainly the signs point to a tempering of demand. That is reflected in the guidance that the business gave. It's reflected in the guidance of the work, or the content of the work we do, which includes tracking things like app downloads and other data points that have shown softening, and we were ahead of that going into the quarter, although that softening has slowed based on the data we look at. But the question is, am I getting good value on this stock now in light of this? And then you brought up the streaming point, which I'm happy to talk about. One of the great parts about the streaming business, not only for Disney, but for the industry at large, is that companies are delivering both subscription and ad-supported streaming services to give the consumer choice. So I think the price points are providing choice. The key is having content that the consumer really wants.
Yeah, if the complaints were about studio and sort of creative choices, your point about Deadpool, Wolverine, and Inside Out 2 are pretty well taken. I do wonder, though, on the sports bundle, if you think that injunction is going to hold.
Well, right now we are planning for Venue, the service which has been put on hold by the courts. We have, from the start, not assumed a material financial contribution from this business for the industry at large. We are certainly in the skeptical camp that Venue at its price point and with what it offered was something of a half measure between a consumer being price sensitive and looking at the price of individual streaming services in the range of, say, $5 to $25, and then the full bundle, especially when it comes from a service like YouTube TV, in the range of $75 to $90. We sort of felt the consumer was still looking at one or the other, and we didn't really see a large segment of the market looking for a $42 service with some of the sports content. So whether or not it holds, it's kind of inconsequential to us. We don't expect it to be a material driver regardless, and we're really waiting for that standalone ESPN service, which is scheduled to come in 2025.